the blue of the limitless sky. I am the inspiration that led success soar high. I will achieve, I will fly high. IDBI in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
On Tuesday, HDFC Bank hiked its marginal cost of lending rate by 35 basis points. Canara Bank and Karur Vyasa followed suit with rate hikes. Last week, SBI raised rates on home loans and other banks announced similar hikes. Not just the lending rates, fixed deposit rates, as some banks have also witnessed an upward revision. The decision by HDFC Bank comes just a day before RBI announced a hike of 50 basis points to the policy rate. While rates are certainly expected to go up again, what remains to be seen is how fast would banks pass through these rates. Good morning, I'm Ishan Gera and I welcome you to the Business Standard Banking Show. In today's episode, we'll bring you up to speed with the important banking developments of the week. But first, here's a look at the banking developments of the week. On Wednesday, the RBI in its June meeting announced the second hike for the year, raising the repo rate by 50 basis points to 4.9%. The governor cautioned about globalization of inflation due to the Russia-Ukraine war. Highlighting the resilience of economic recovery, the governor noted that inflation has crossed the upper band and shall stay that way for the upcoming 3 quarters of FY23. He hinted at the return of normal monetary policy conditions in a calibrated manner. While the CIR has not been changed for now, the inflation target was revised upwards by 100 basis points to 6.7%. The growth figures remain unchanged from the last policy meeting at 7.2%. Talking about decisions impacting banks, the central government has picked up the mantle of bank privatization again. Last year, in her budget speech, the finance minister had recommended privatization of 2 public sector banks along with IDBI Bank. But then, the bill to allow this was not tabled in Parliament. Now it is making quick moves to achieve this goal. Although the centre is yet to produce the preliminary information memorandum that would include eligibility conditions for the sale of IDBI Bank, Business Standard learned that the criteria may allow banks to place bids subject to a merger plan approved by the RBI. This would allow commercial banks to take up a stake in the entity. NBFCs looking to lap up their stake will have to create a non-operative financial holding company (NOFHSC) as per RBI's guidelines. Liberalization of rules is happening not just in the banking sector but the insurance sector too, which is set for an overhaul. Just a few months after joining as Insurance Regulatory and Development Authority of India, former Financial Services Secretary Debashish Panda is making moves to open the sector. Last week, IRDAI announced that it has extended the use and life feature for all health insurance and almost entire general insurance products. So insurance companies can introduce new products without prior approval. The reform will allow insurance firms to create new products, making the market more competitive. From insurance, let's shift our attention to mortgages. Ever since HDFC Bank announced their merger, markets have been abuzz with what shape the new entity would take. Last week, Shashidhar Jagdishan, MD and CEO of HDFC Bank, said that post-merger the lender will more than double its profits as well as the size of its balance sheet in 5 years. He also announced that the bank will add 1,500 to 2,000 more branches in the next 3 years. Just this week, HDFC chairman Deepak Parekh, in a letter to shareholders, said that the country should be able to double its home loans to around $600 billion within the next 5 years. From the country's soon-to-be largest private sector bank, let's move on to India's largest banking entity. Just before the rate announcement, our banking editor Manojit Saha had the opportunity to sit with SBI chairman Dinesh Kumar Khara to discuss the bank's growth strategy. Interestingly, he said that credit growth would not be impacted this year and may even trump last year's growth figures. Let's listen into their discussion.
Welcome to the Business Standard Banking Show. The last financial year, public sector banks reported a very healthy turnaround, and SBI also reported a healthy top line and bottom line. However, the outlook for the current financial year is clouded by inflation, which prompted the Reserve Bank of India to start increasing interest rates. To talk more about the Indian banking sector and about SBI, we have Dinesh Kumar Khara, Chairman, State Bank of India, with us today. Mr. Khara, welcome to the show.
Thank you. Thank you very much.
The first thing, let me start by asking you that SBI has reported very healthy loan growth in the quarter 4. Most important part is that corporate loan growths have come back. Do you see this trend continuing in the current financial year?
Yeah, certainly, because essentially when we look at the loan growth which we have witnessed in the last quarter of the last financial year, it is essentially attributed to the better utilization of the working capital limits for the large corporates and also availment of the term loan facilities which were sanctioned. So I think that trend still continues, and apart from that, we have got a healthy pipeline of the proposals which are under process. So that actually augurs well for the likely corporate credit growth also. The other very important factor is that the capacity utilization has improved in the economy. It has moved up beyond 72%. So invariably we have seen that as and when the capacity utilization improves beyond a threshold, it certainly leads to better utilization of the working capital. Apart from that, our retail engine continues to do very well. So that I think will continue to be there in the current financial year. And apart from that, we'll have the support coming in from the corporate side also. So that's why I hope that we will have a decent credit growth in the current financial year too.
So in this current financial year, you expect a better credit growth than the previous financial year?
We expect that at least it should be at the same level, if not better. It could be better too.
It could be better too. Sir, in the last few days, the liquidity situation has slightly tightened. The kind of surplus liquidity we have seen in April has suddenly come down now. Do you think that could impact loan demand to some extent?
As far as we are concerned, we are quite comfortably placed, and we have got a decent AFS book also, which enables us to ensure that there should be enough liquidity for all the times to come. If at all we will see a decent growth in credit, we can always make that book also available for supporting. But nevertheless, if I look at the YOY growth in terms of the deposit as well as advances, I am seeing healthy trends both in deposit and advances. So I think that gives me a confidence that as far as SBI is concerned, no challenge.
So coming to retail loans, as the interest rate scenario is changing, interest rate going to go up. Do you think the retail credit growth momentum could continue despite interest rates going up?
We have seen positive trends in terms of the retail loan growth. And I would also like to emphasize that when it comes to retail loans, even the borrower will also look at their EMI to NMI ratio.
Right.
And invariably, we have seen that during inflationary conditions, even the salaries also increase. So to that extent, if at all loans are contracted at a particular rate of interest, then perhaps, invariably we have seen that it makes sense for the borrowers to create an asset by raising leverage.
Right.
So invariably, the asset prices will keep on improving during inflationary conditions.
Right.
Whereas the repayment obligation remains almost constant or marginal increase.
Right.
So to that extent, it is beneficial for the borrowers to create assets by raising leverage. And that actually gives me the confidence that we should continue to see the robust growth for the retail loans as well.
Coming to asset quality, SBI has improved healthy asset quality number. Asset quality has improved in the fourth quarter. Going ahead, there are two specific issues. One is the loans given to the salaried class, because we are seeing some pressure in the tech-related sectors. A lot of these people took loan using the SBI YONO app, which is a very popular app. Do you think some pain coming from the salaried class because of the attrition or the layoffs which is happening now?
These loans which have been given, personal loans or the express credit loans, are given to the corporate salary package customers.
Right.
And a very significant part of that are the government employees, public sector employees, defense forces. So they are the kind of people who have availed these loans. So the kind of stress which you indicated, we actually don't witness that kind of stress. When we look at the quality of our retail loan book, the NPA percentage is very low. So I think that is something which we are very proud of having underwritten an excellent book. And we don't envisage any challenge for our retail loan book.
Other issue is the SME loans. SBI has about 25% CAGR in the last 2 to 3 years of the SME loan growth. Now, SMEs are also facing some problem. They are facing volume pressure. Do you think SME could be a potential risk, a potential concern for you going ahead?
Our experience till now does not suggest us. We have been very careful in terms of ensuring that the credit quality of the bank remains the top class. And in the past also, we have said that if at all we visualize even a slight indication of a stress, we rather believe in providing for such stress even much before we are required to provide for in terms of the regulatory prescriptions. And that is one of the reasons why our PCR ratio now stands at 90% plus. So that way we have built up enough cushion within the balance sheet for even the remotest possibility of the stress. And I don't expect any kind of a challenge on this count.
Coming to sir capital, your capital adequacy was close to 14%, 13.83% as on March end. Given the kind of growth you are looking at, do you think you will be raising equity capital in the current financial year?
I think we will be taking a call. As of now, the kind of growth which you are visualizing for the current financial year, we are well equipped to provide to support that kind of a growth with the current capital adequacy. If required, we'll be raising some tier 1, tier 2 bonds, depending upon how the situation really pans out.
So right now, no plan to raise?
As of now, we have not really gone to the board with any kind of a proposal for the capital raise.
Are you not looking? Are you looking to list one of the subsidiaries, the SBI General Insurance or the SBI AMC mutual fund?
We have nurtured these subsidiaries over the period of time, and we would like to take them to market at the right and opportune time. So that's what I believe, and that's what we will be doing.
Because that is also an option for you to raise capital.
Absolutely,
for the bank.
anytime.
But
So those are the pockets which you will avail, but I don't want to really compromise when it comes to listing such entities at a point of time when perhaps they may not fetch the right price.
right. So I mean, you have not taken a call.
Right and opportune time would be the guiding factor in this.
Sir, tell us something about the margins. In a rising interest rate scenario, I mean, do you think you will be able to protect your margins?
Almost about 75% of our book is linked to MCLR, EBLR, or Repo. So that way, in the rising interest rate scenario, normally it turns out to be beneficial for the banks which have got the floating rate of interest as compared to fixed rate. So I think we are very well placed in that context.
On the other hand, CASA, in a rising interest rate scenario, people tend to put their money more in fixed deposits and not in CASA deposits. We have seen SBI's CASA ratio fallen in the fourth quarter. How do you see the situation going?
CASA is invariably a portfolio which is very, very, it goes through volatility.
Right.
And particularly because if at all it is evaluated on a particular day, and then it will depend upon how people have utilized their current accounts. If they have withdrawn money from their current account, and invariably it is so, on 31st of March, invariably we have seen that the corporates and even the governments also, they withdraw their the funds which are lying in the current account for deployment for the purposes for which it was intended. So that is something we have seen, but normally it has been in the range of about around 46%.
Correct.
So it has remained more or less in the same range, marginal movements here and there. So not really worrying as much, but yes, of course, it is also linked to various technology solutions which are being offered by the bank, and our technology bouquet and the products are increasing every day. So I'm sure going forward, we should be in a position to give it more stability, or maybe we will be in a position to improve it also marginally.
Right. Treasury operations is another area where this is much talked about because yields are rising. How do you see your treasury profits going ahead? Is there any discussion with the regulator for some dispensation? amortizing the losses over a few quarters?
No, there are no such discussion. And see, the fact of the matter is that even RBI has already given permission for putting 23% of the NDTL into the HTM category.
Yes.
So that actually, in a rising interest rate scenario where the yields and the coupons are increasing, actually that gives another muscle for the banking system to earn better yield and also to take care of the MTM losses which might be there in the AFS book. So that is one part of the story. But the other part of the story is that if at all we witness a decent credit growth, we'll be in a position to shrink our AFS book also, and we can deploy that money for more productive uses through the credit offtake. So that will also help us in actually reducing our MTM. And on the top of it, our MTM, as far as when it comes to the duration, portfolio duration would be less than 2 in the AFS book. So that is something, these are the kind of things which actually gives us some kind of a comfort. And apart from that, last year we had provided for the security receipts also, which was almost about 3,600 crore, which we provided. And this year we don't have any such obligation to provide for. So to that extent, we have created an elbow room in the treasury book also to withstand any such impact which might be there for on the AFS book during the rising interest rate scenario.
Right. Mr. Khara, thank you so much for talking to Business Standard.
Thanks a lot. Thanks for giving an opportunity. Thank you. Thank you.
Storms in May and June are par for the course in the city of Delhi, but the thunderstorm it witnessed a fortnight ago left a strong impression. Delhi faced unprecedented turmoil as the storm wreaked havoc, uprooting trees, electricity poles, and flattening many cars. Does insurance cover these kind of damages to a car? Are cars protected from the damage caused by a natural calamity? A comprehensive cover may be the right answer. Listen to what our experts have to say about it.
Did your car get damaged in a natural calamity? Did a tree fall on your car? Will your insurer cover the damage to your car caused by natural calamities such as thunderstorms? Yes, it will, but only if you have comprehensive motor insurance cover for your vehicle. Essentially, a comprehensive motor insurance policy includes an own damage cover and a third-party liability cover. An own damage cover insures a vehicle owner from damages caused to the vehicle by natural disasters, accidents, man-made disasters, fire, and theft. Third-party insurance cover, which covers a vehicle owner from third-party liabilities, is mandatory for all as per Supreme Court's directions. But own damage cover is not mandatory, so some vehicle owners tend not to buy an own damage cover. Thus, one needs to have a comprehensive motor insurance policy if one wants to cover the damage to their vehicle caused by natural calamities. So, what should you do in case your vehicle is damaged in a natural calamity? As a vehicle owner, the first thing you need to do is to collect all the evidence of the incident in the form of photographs and videos of the damaged vehicle. Also gather newspaper articles that support your claim of a natural calamity having occurred on that day or night. Moreover, don't move your vehicle from the place where the damage occurred. The insurance company's surveyor will inspect and evaluate the damage to the car and submit a report to the insurer. The surveyor will check the extent of the damage and assess whether the car can be repaired or the loss is total. If the cost of repair and retrieval of the vehicle is more than 75% of the insurance declared value or IDV, then it is considered to be total loss. In case of total loss, the insurer pays the IDV of the car to the policyholder. If the damage can be repaired, then the next step depends on whether the settlement will be cashless or not. In case of cashless settlement, the insurer will pay the garage directly. Else, the owner of the vehicle foots the bill which he or she then submits to the insurer and gets the claim settled. So, the answer to the question whether your car insurance will pay for damage caused by a natural calamity, the answer is it depends on which policy you purchase.
I am the blue of the limitless sky. I am the inspiration that led success soar high. I will achieve, I will fly high. IDBI in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
A comprehensive cover can protect you from all kinds of damage. But how far is inflation hemorrhaging the Indian economy? In his latest announcement, the RBI governor informed that the bank now expects inflation to touch 6.7%, while growth forecast has been kept the same at 7.2%. Our banking expert, Tamal Bandyopadhyay, makes sense of RBI's decision and the governor's statement. Hi Tamal, thanks for coming on the show.
Thank you.
It's great to have you on the day the meeting minutes are announced. The RBI announced a 50 basis point hike, but the policy guidance also hinted at a 6.7% inflation and other risks emanating from unhinging of inflationary expectations. Now, this is very much in line with the column you wrote just a few days before the policy, where you highlighted a 50 to 40 basis point hike, unchanged growth, and inflation at 6.5%, if I'm not mistaken. Do you think we'll stop at the pre-pandemic level of 5.15% or cross it in the next meeting itself?
No, definitely not. I would like to believe the way it's been drafted, his statement, he would not. I would expect another 50 basis point hike in the next policy in August. Yet another in September, which actually planned to be in October, but has been advanced to the last week of September. So I would like to believe we need to reach definitely 5.15 is not the destination. And if you had been at the Reserve Bank of India governor's post-policy media conference, he did mention that we are our current rate is lower than the pre-pandemic level, yes, and current liquidity is higher than the pre-pandemic level. So while 5.15% rate is sort of could be the immediate goal, which we thought earlier, but now 1 full percentage point raise and the inflation forecast. So when you have 6.7% inflation, which yes, is 70 basis points higher than your upper band, mm-hmm, and also governor said the first 3 quarters it will not come down. Okay, yes, it will come down to around 6 only in the 4th quarter.
Yes.
So I would like to believe the pause happens after a series of rate hikes, which already started. 2 of them happened last month and today. Another 2 to 3 hikes. So definitely in August and September, probably even in December before it takes a pause. Now, what would be the pause point? Is it 5.5 or 5.75? I don't know, because it's an evolving situation. There are many ifs and buts. It's a very fluid situation. But one thing is for sure, that RBI has changed the script. It has fallen in line with the global central bank. But now it's a familiar central bank script. Inflation is enemy number 1. You have to fight inflation. And the only way to do this is hiking rates, and which is started. It's a second in the series. I would expect another 2 to 3 hikes by December. So around 5.5, and ultimately we may go to 6 and above, depending on how the situation unfolds.
It's interesting that you mentioned that, because there was a term called globalization of inflation that was mentioned in his remarks. Now, and talking about liquidity, because there was no CRR hike this time around, can we expect one next time, or is the liquidity being managed without the CRR hike? And what do you make of the governor's statement in that regard?
So it's a little technical part. I'm afraid I'll try to make it as simple as possible. In the new liquidity framework, which is about 2-year old, it talks about, it's now it's a 50 basis point corridor. Within that corridor, policy rate is at the middle, and then you have MSF at the top end, and the new instrument which has replaced reverse repo at the bottom end, yes, right? So now the policy rate is what is 4.9 with the latest report is 4.9. Yes. So which means 4.65 is the lower end of the corridor and 5.15 is the upper end of the corridor.
Yes.
But if you see the weighted average of call money rate, it should be at middle somewhere. So it has to go up. Now, will we see another round of CRR hike? Because last month it had sucked out 87,000 crore by raising 50 basis point. I think we need to wait and watch, because how much is the government spending? So there are many variables how the liquidity, excess liquidity pans out. So we need to watch, but I will not rule out. If I see that liquidity, I mean, if the governments are, there's a leakage, and then the government spending huge, then again liquidity may come back. So it all depends on and how much Reserve Bank of India active in the foreign exchange market and how it does. Because if it is selling dollar, then to that extent rupee is sucked out. Liquidity is drying. But if it sells dollars in the forward, then will not have any immediate impact on the rupee liquidity.
Exactly.
So there are many variables. At this point of time, liquidity is coming down, but still there is adequate liquidity, plenty of liquidity, which is why I would say it's not even though the word accommodation is not anymore, it's withdrawal of accommodation, that is the stance. But you look at the liquidity scenario, it's not even neutral policy. We need more liquidity to be drained. And let's wait and watch how it happens, how it pans out.
Now, within this paradigm, I would like to take you back to the topic of appropriate and adequate liquidity, which you discussed in your Bankers Trust this week. Does the current policy change your assumption about RBI graduating towards appropriate liquidity or not?
No, that word is not there. This term actually Dr. Reddy used to use as a governor. And it's a very nuanced central banking language. There is a difference between ample and adequate and appropriate. But the governor's statement and the MPC has been continuously harping on adequate liquidity, of course with a caveat for the productive purpose, because it does not want to harm the growth and the credit of tech.
Yes.
But I would like to believe it's time to talk about appropriate liquidity, because there is the fine difference between adequate liquidity and appropriate liquidity. We continue to have adequate liquidity, which is why I would say that even though the focus is on withdrawal of accommodation, I will not call it even neutral. Liquidity does not say that even is a neutral stance. Forget tightening.
Got a point. Now, one of the points that I found very odd was that in overplaying of economic resilience, is RBI falling into the same fallacy again as it did earlier? Because comparisons were made to the emerging markets and how India has shown resilience. What do you think about that?
RBI 7.2% just remain unchanged, and I think it is achievable, doable, unless things are dramatically turn worse. At 7.2, we are far better off than many other countries. But the point is, your question is it sustainable? We are getting into a trap. If you look at today's policy, governor is more confident on the growth part, but huge concern on the inflation, which is why priority is very, very different. Will we change growth estimate downward? We need to see, because apart from everything else, the higher interest rate has an impact over the demand, because 40% of the credit now is the external benchmark linked. And this external benchmark is either repo or 364-day treasury bill. Now they are rising. So, and all the MSME loans, all retail loans from 2009 December onwards have been linked to, and the banks are very fast in passing on, so which means your mortgage loan or your auto loan has gone up by 40 plus 50, 90 basis point, and it will go up by another 75 basis point odd in the next few months. So will that create instability? Even I'm talking about financial sector stability, because this will hurt the MSME segment. This will hurt the retail segment. So it will hurt banks' balance sheets, and of course it will impact demand. So it will have an impact on growth. Now, will RBI take a relook and bring it down? I think we need to wait how it pans out. Probably not in. I'm not expecting it to do it in August or even in September, but probably in December we will get to see, because there's always a lag effect.
Thank you. Thanks a lot for talking to us today. We hope to have you back again soon. Thank you.
Thanks. Thank you.
The most important question is whether the pre-pandemic ceiling of 5.15% will be breached or not, and if so, how fast? That's all for this week. We'll be back on Thursday at 11 a.m. with more news and analysis. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.